I'm 32 years old, and for pretty much my entire adult life, I've been investing. That sounds like a long time, but what's really wild is that in just over a decade, I've lived through some of the most dramatic market swings in recent history: the post-2008 recovery, the crazy crypto boom, the pandemic crash, the AI rally. It's been a roller coaster. And if there's one thing all these ups and downs have taught me, it's not about finding the perfect stock, but about understanding my own relationship with risk. It's the single most important lesson, and it's what I want to talk about today, because knowing how to handle the inevitable downturns is what separates those who build wealth from those who get wiped out. Did you know that over the last century, the stock market has returned about 10% per year on average? Yet, so many people lose money. How is that possible? It's because they sell at the worst possible time when fear takes over. We see our portfolios dropping, panic sets in, and we hit the sell button to stop the bleeding. I've been there. I remember looking at my account during the March 2020 crash and feeling that knot in my stomach. The temptation to just pull everything out and wait for things to calm down was immense, but my experience, even by that point, had taught me a crucial lesson. The market always comes back, always. The question isn't if, but when. And your job as an investor isn't to predict the bottom, it's simply to stay in the game long enough to see the recovery. So how do you do that? How do you stomach the fear and not just survive, but actually thrive during market cycles? For me, it comes down to a strategy that's so simple, people often overlook it. It's called dollar cost averaging, or DCA. I know, it sounds like financial jargon, but I promise it's incredibly straightforward. All it means is investing a fixed amount of money at regular intervals, regardless of what the market is doing. For example, you decide to invest $200 every single month into a broad market index fund, like one that tracks the S&P 500. You set it up to be automatic, and then you just let it run. Here's why this is so powerful, especially when markets are volatile. When prices are high, your fixed $200 buys you fewer shares. But when the market dips and prices are low, that same $200 buys you more shares. You're automatically buying more when things are on sale and less when they're expensive. This simple act removes the two biggest enemies of the average investor: emotion and timing. You don't have to guess if it's a good time to buy. You don't have to panic when prices fall. Your strategy is on autopilot, consistently building your position over time. This is how you turn market risk into an opportunity. Let's break it down into practical steps you can take right now. First, figure out how much you can comfortably invest on a regular basis. It doesn't have to be a huge amount. Even $50 or $100 a month is a fantastic start. The key is consistency. This should be an amount you can stick with even if you have an unexpected expense pop up. Think of it like a subscription you're paying for your future wealth. Second, choose what you're going to invest in. For beginners, and honestly for most people, a low-cost, broad market index fund or ETF is the best choice. Something that tracks the entire market, like the S&P 500 or a total stock market index. This gives you instant diversification. You're not betting on one company. You're betting on the long-term growth of the economy as a whole, which historically has been a very good bet. Third, and this is the most important part, automate it. Go into your brokerage account, whether it's Fidelity, Vanguard, Charles Schwab, or any of the newer apps, and set up a recurring investment. Choose your amount, your chosen fund, and the schedule, like the 1st or 15th of every month. Once it's set, you don't have to think about it. You don't have to log in and be tempted to meddle. The system just does its thing, month after month, year after year. This automation is your secret weapon against your own brain. Our brains are wired for survival, not for long-term investing. When we see red in our portfolio, our fight-or-flight response kicks in. We want to do something, anything, to make the perceived danger go away. Automating your investments takes that decision out of your hands. It forces you to stick to the plan, which is the hardest part of investing. Now, I want to be really honest. This strategy isn't glamorous. You won't get a 1,000% return overnight. You won't have a wild story about a meme stock to tell at parties. This is the slow, steady, and frankly, kind of boring path to building wealth. But you know what? It works. It's the strategy that has allowed me to sleep at night during market crashes. It's what has allowed my portfolio to not just recover, but to reach new highs after every single downturn. The real risk in investing isn't the market going down. That's a normal, expected part of the cycle. The real risk is being unprepared for it. The real risk is having a strategy that relies on you being a perfect, emotionless robot who can time the market perfectly. But we're not robots. We're human. We get scared, we get greedy, and we make mistakes. A good investment strategy isn't one that pretends these emotions don't exist. A good strategy is one that is built to protect you from them. Dollar cost averaging does exactly that. So, when the next market downturn comes, and it will come, I hope you remember this. I hope you see it not as a reason to panic, but as an opportunity. It's a chance for your regular, automated investment to buy more shares at a discount. It's your strategy working exactly as it was designed to. Every market cycle I've been through has reinforced this one truth: time in the market is infinitely more important than timing the market. Stick with your plan, stay consistent, and let the power of compounding in market cycles do the heavy lifting for you. My journey from being a 20-something who was terrified of losing money to someone who now sees market dips as a feature, not a bug, was all about embracing the simple, powerful idea. It's about playing the long game. What are your biggest fears when it comes to investing in a down market? I'm genuinely curious to hear your thoughts and questions. Drop them in the comments below, and let's talk about it. Thanks for watching, and I'll see you in the next one.